Hello everyone and welcome back to another video. My name's Sam and today we'll explain what leverage in trading is while also providing clear examples to help you completely understand how it works. But before we delve into this exciting topic, we want to hear from you. Got any burning questions about leverage or perhaps some insight you would like to share? Drop them in the comments below. And as always, stick around till the end of the video so you don't miss out on anything important. Let's begin. Leverage is a fascinating concept that plays a significant role in the world of trading. It essentially empowers traders to command a larger market position with a relatively smaller capital investment. This means that with leverage, traders can potentially enjoy higher returns, but it's important to note that losses can also be magnified. Many CFD platforms, especially those focused on forex, stocks, options, and futures trading, offer leverage to their users. However, the availability and extent of leverage may vary depending on the platform, the type of assets being traded, and the regulations governing that platform. Imagine you want to buy a house that costs $200,000. You don't have $200,000 in cash, so you go to the bank and make a down payment of $20,000 or 10%. And the bank loans you the remaining $180,000 to buy the house. This loan, or mortgage, allows you to control a $200,000 asset, in this example the house, with just $20,000 of your own money. In trading, leverage works in a similar way. Let's say you want to invest in the stock market and you have $1,000. By using leverage, such as borrowing money from a broker, you can control a much larger position in the market than you could with just your $1,000. For instance, with FXGT's 1,000 to 1 leverage, you could control $100,000 worth of stocks with just $100. However, just like with a mortgage, there are risks. If the value of the house decreases, you still owe the bank the full amount of the loan. Similarly, in trading, if the value of your leveraged position falls, you're responsible for the losses of the total position. On the flip side, if the value of the house or your investment goes up, you benefit from the increase on the entire value, not just your initial down payment or investment. This is how leverage can amplify both gains and losses in trading, just as it does with buying a house with a mortgage. Essentially, trading with leverage in the short term can be likened to buying a house with a mortgage, then waiting for its price to rise or fall before selling it and paying back the mortgage to the bank. For example, imagine you bought the house we said earlier worth $200,000 using a loan of $180,000 from the bank, along with your down payment of $20,000. Later, if the house's value increases and you sell the house for $210,000, you can pay back the $180,000 loan to the bank and be left with your original $20,000 plus an additional $10,000 in profit. This illustrates how leverage allows you to expose yourself to a larger position size, enabling you to profit or incur a loss from the difference in the buying and selling price of the increased position size. The key takeaway is that leverage magnifies both potential gains and losses based on the full value of the position, not just the amount of your initial investment. At this point, it might be a good idea to also mention margin call. Margin call occurs when a trader's account falls below the required maintenance margin level set by the broker. This typically happens when losses on leveraged positions deplete the available capital in the account. Margin calls are triggered when the account's value minus any borrowed funds, in other words, the account's equity, falls below a certain percentage of the total margin required to maintain open positions. Traders can prevent margin calls by carefully monitoring their positions, setting appropriate stop-loss orders, and maintaining sufficient funds in their account to cover potential losses. Effective risk management strategies are crucial to avoiding margin calls and preserving capital. We'll tackle margin calls, stop-loss orders, and risk management strategies in detail in our upcoming videos. But for now, let's take a look at how leverage varies from market to market. In the stock market, traders can use leverage through margin accounts provided by brokers. Margin requirements and leverage ratios vary by broker and can be subject to regulatory oversight. Trading on margin allows investors to amplify their exposure to stocks, potentially increasing both profits and losses. Leverage in the Forex market is typically much higher compared to other markets, with ratios ranging from 50 to 1 to 500 to 1 or even higher in some cases. This high leverage enables traders to control large positions with relatively small amounts of capital. However, it also increases the risk of significant losses, especially in volatile currency markets. With commodities, leverage allows investors to control contracts for commodities like gold, oil, or agricultural products with a fraction of the total contract value. Margin requirements and leverage ratios can vary depending on the commodity and the broker. And finally, leverage is also available in cryptocurrency trading, enabling traders to speculate on the price movements of digital assets like Bitcoin, Ethereum, and others. Leverage ratios in cryptocurrency trading can be high, but traders should be aware of the extreme volatility and risk associated with the crypto market. Each market has its own dynamics and considerations when it comes to trading on leverage. Understanding these differences is essential for traders to effectively manage risk and capitalize on opportunities in their chosen market. Alright, so let's summarize what we've learned in this video. Leverage empowers traders to control larger market positions with smaller capital. Understanding leverage ratios is crucial to grasp the potential gains and risks. Margin is the amount of money traders need to maintain leveraged positions. Low leverage minimizes potential losses while maximizing your capital's impact, while high leverage allows you to trade larger positions but with more risk, whilst there are other types of leverage to help you get the most out of your trading needs. Each market has its own dynamics and considerations when it comes to trading on leverage. And that's it for leverage. Let us know if you'd like to see a more advanced version of this topic in the comment section down below. Don't forget to like the video and subscribe to our channel. And hey, since you made it this far, here are 2 more videos that you might like. I'll see you next time.